So one of the bonds issuers that I particularly like, and I think there's a list of them that you may refer to in the report which we have published, is the Straits Trading Company. So just to give you more information about this company, it's actually he has a rich history dating back to the early years of Singapore's colonial past. In the 1900s, this name has become synonymous with tin smelting. It's actually renowned for producing the purest quality of tin in the world. So after 25 years after its incorporation in 1887, the tin production actually accounted for about two-thirds of Malaysia's output. So since then, the company has grown and expanded into other businesses, including property, hospitality during the 1960s. And in 2008, it was actually acquired by the Khan's Private Limited, which is an existing controlling shareholder and member of the Tisatiti Group, which is a privately held firm funded by the late Dr. Tan Chin Tuan. So this is a diagram of the group's corporate structure. It's 75% owned by T-City Private Limited. And then there are also different companies which it owns. For example, it owns 54% of Malaysia Smelting Corporation Berhad, which is the largest independent custom tin smelter in the world. And then they also have a 22% stake in ARA Asset Management. So this morning we had the announcement that ARA Asset Management is going to be acquired. And so this would naturally boost the equity level of this company. In fact, if you look at the price of this company, which is trading on Singapore Stock Exchange, it actually jumped up quite significantly. Of course, there are also other subsidiaries within the group, like Straits Development Property, which is in charge of the company's developments, for example, the Straits City project. So this company has a big stake in MSC, which is the Malaysian Smelter Corporation. Is a tin company. So tin is widely used in electric vehicles. For example, lithium-ion batteries. So the electric vehicle market is projected to grow by 27 million units by 2030, so at a CAGR of 21%. So given that it has a big exposure to tin prices and there's a big demand in the electric vehicle market, we think this company could benefit. Of course, we could possibly see a higher EBITDA moving forward. And tin is not only used in electric vehicles, it's also used in advanced robotics. So the global market for robotics is expected to grow at a CAGR of approximately 36% to reach about 210 billion by 2025. And then we have renewables, which will account for 30% of power demand in 2023. So again, tin is widely used in these various industries. And if we look at tin prices, which is shown on the diagram here, tin prices have gone up quite significantly. In fact, the highest level since the 1990s. And this would be beneficial to the company. So looking at EBITDA breakdown, I think its EBITDA has improved over the past couple of periods, increasing from 37 million in the first half of 2020 to about 106 million in the second half of 2020. If we look at its EBITDA, most of it is coming from Straits Real Estate. So 89% of Straits Real Estate, which is its real estate the assets are actually income generating, and these help to provide a stable stream of cash flow to the company, even though during the pandemic. So they divested 9 properties in Japan recently and would be riding on the rise of e-commerce, and it'll be expanding its portfolio of built-to-suit logistics properties in Australia and South Korea. So looking at the snapshot of its credit profile as of December, we noted that the cash position has improved from 310 million to 456 million, and that's nearly equal to its short-term borrowings. But I think looking at the cash flow, I think looking at its tin exposure, I think if we couple with the operating cash flow, the cash and cash flow position will be higher than the short-term borrowing. So looking at net debt to total equity, 42% is still healthy. EBITDA to interest expense is also pretty decent and adequate in our view at 4.5 times. So the bond which we are recommending is 3.75% 2025 bond. So this is the performance of the bond. It's quite stable, and the yield is possibly between 2.8 to about 3.2% right now. So the other issuer, which I think is also good, is Olam International. So I've been highlighting this company for quite some time. Olam is actually a global supplier of raw and processed agricultural commodities. So given that we have inflationary environment and part of it is driven by higher commodities, so this company would naturally benefit. The company operates a worldwide supply chain that spans over 60 countries, providing ingredients to over 25,000 customers. So it's clearly a very big company. It's listed on the Singapore Stock Exchange. It's one of the biggest top 30 by market capitalization. Temasek is a shareholder of the company, as well as Mitsubishi Corporation. So if you look at the headlines recently, weather patterns are changing. I mean, in Singapore, we're also seeing like more rains, and then we have floods. And not only that, but I mean, in other countries, these weather patterns, like in Europe or even in China, Henan, and then we had the headlines from Bloomberg News saying that, La Nina is giving a turbocharged boost to already high food prices. So the prospect of US drought and difficult weather almost everywhere else has prices soaring. So this is from Bloomberg News. Bloomberg News also says that while weather plagues North America grain crops as demand surges, and this was in an article in June, and then the Economist has also noted the higher food prices that has recently soared and they say that big agriculture is having a field day. So companies that are in this field are doing well. If you look at prices since 2016, prices have gone up. Here we have the cocoa futures, coffee futures, and cotton futures, as well as the index for agricultural prices. So they have broken out recently in 2020 since the pandemic. I mean, we all know that during the pandemic, there was this a rush for food. The supermarkets were empty, and people thought there was this propensity to consume, and there was low supply. And as a result, we see higher food prices. Part of it has also driven more agricultural prices to go up. So Olam is actually one of the biggest suppliers of cocoa, cotton, and coffee. So if we look at coffee, which is the orange line, it has gone up to the highest level in years, and this is due to frost in Brazil and also weird weather patterns in Brazil. So that is the reason why coffee prices are quite high right now. So Olam, if you look at its earnings recently in the first quarter of 2021, that will be March, comparing to the first quarter of last year, sales volume has improved slightly. Revenue, however, has increased by 14.5% to about 8.8 billion. Profit after tax, including minority interest, is about 155 million. So there's still decent. Operational PATMI, which is profit after tax, including minority interest, is also about 157 million. So looking at its balance sheet, the company has a high gearing, no doubt about that. I mean, if you look at the net debt to equity, it's about 172%. So that's high. But if we adjust it, meaning we adjust this gearing for its readily marketable inventories as well as secured receivables, the adjusted net debt to equity would drop to 50%. So 50%, I think it's pretty adequate. If we look at how they can pay their debts, they may actually use their inventory. This inventory is made out of commodities, so they are liquid, or they may tap on its credit facility or even its cash position. So we are recommending the Olam 5.375% PERP, which has gone up quite significantly. I mean, the past couple of days has gone up. Now it's trading about, I think, 102 with the ask yield to call of about 4.8. So it's callable in about 5 years' time. So we think that this is an attractive investment that investors may consider. So with that, I come to the end of my part, and those two would be my two recommended issuers. And I'll pass it on to Churen.
Thank you, Dexter. So in the Q&A, somebody was asking about Asian REITs. So good news is I'll be covering two Asian REITs bonds today. First will be ESR Cayman, followed by Lipo Malls Indonesia Retail Trust. So about ESR Cayman, they mainly have three same segments for revenue. Firstly, the investment segment, where they recognize rental income and capital gains on properties that they hold, or dividends and fees from managing REITs. So the fund management segment, they earn recurring fee income from managing properties held by funds and investment vehicles. For example, some people who invest in ESR will be GIC and Manulife. And lastly, the development segment, where they profit through the development and sale of logistics properties. So for the most recent operating results, which is for the year 2020, the profit for the year, they had profit for the year, unlike other REITs, but growth also slowed. So revenue from investment segment declined by 11.5% year on year to $107 million due to the disposal of property league assets to the ESR Australia Logistics Partnership. About 64% of ESR Cayman's tenants are in the e-commerce and third-party logistics industries, which have been growing despite COVID-19. And Euromonitor also projects e-commerce penetration rates to increase in APAC, which benefits ESR as well. They mainly invest in APAC, the APAC region. So for the fund segment, total AUM grew by 35% year on year in 2020 to almost $30 billion USD, resulting in a 13.5% year on year growth in fund income to $109 million USD. So ESR Cayman manages 34 private third-party investment vehicles and 3 publicly listed REITs. One of them will be ESR REIT. So as I mentioned earlier, investors include GIC and Manulife. For the development segment, revenue grew by 31.9% year on year to $92 million due to higher demand for logistics properties. So ESR Cayman has a land bank gross floor area of 3.7 million square meters and development pipeline gross floor area of 15.5 square meters. So the completed investment properties and investment properties under construction also amounted to $1.45 billion and $1.21 billion respectively, which indicate quite a healthy pipeline of revenue in the future. So in this year, they, together with GIC Private Limited, will be acquiring an Australia property portfolio of unit trusts holding 45 industrial and logistics real estate assets. I think recently it was just completed. So the acquisition is made with a 20-80 split from the Blackstone Group, Inc. And ESR will fund about $753 million, which is about 20% of the consideration. So the portfolio has an initial yield of 4.5% and weighted average lease expiry of 6.9 years. So the FY20 net profits before tax for this portfolio was AUD 281.5 million, and they will be acquiring the properties on a 100% occupancy basis with 2 years of rental support. So the acquisition will be funded by cash. We estimate cash balances to drop to about USD 930 million, which is more than enough to cover for its USD 733.6 million of bank loans expiring this year. We also estimate the credit ratios following the retap of perpetual bonds that was made earlier, I think in June, in May, late May. So their gearing ratios still remain quite stable, and we estimate that the net gearing ratio, which is net debt over equity, will increase to about 60.57%. So looking at their bonds, fixed rate bonds, which is, we recommend the 7.87.5% April 2022 USD bond, which gives about 3% yield in USD. So this shows the yield if you swap it from USD to SGD. Prices have come down quite a bit, and if you look at the 2025 bond, is also quite attractive at 3.74%. For its perps, we compare to other REITs also, for example, Era Logos Logistics Trust, Tree Logistics Trust, and GLP, which is a private firm. So ESR Cayman has the best gearing ratios among the other REITs for 2020, but after accounting for their acquisition, then we expect net debt to equity to increase also. If you look at the chart, then ESR Cayman, the perp, has the highest yield, and that is because ESR Cayman also has the lowest interest coverage ratio as compared to all the other perps. However, we think that ESR Cayman still has quite a good credit profile, and it is offering quite attractive yield of 5.4% for the perp as well. So the next one, I'll be talking about Nippon Malls Indonesia Retail Trust. In short, I will call it Lamir Trust. So they have 22 malls and 7 retail spaces in Indonesia, located in Greater Jakarta, Bandung, and etc. The sponsor is Lippo Karawaci, whose CEO and director is Mr. John Rayodi, and they are rated B1 by Moody's. So last year, Lamir Trust was in some trouble, which almost resulted in a non-payment of distributions for the 6.6% perp. But they seem to be getting their finances under control after the rights issue. So they paid the December distributions that was owed in March, and then they acquired Lippo Purimall through the right issue. They also issued this 2026 bond in February, thus bolstering their balance sheet, and also refinanced 30 million of term loans in April. So in 2020, because of the lockdown and COVID-19, net property income fell by 56.7% year-on-year to Sing dollar 76.4 million. Net income fell by 85.7% year-on-year to Sing dollar 16.8 million. So when they opened in July, they operated at shorter operating hours of about 8 hours. And after fair value and currency losses, Lamir Trust suffered total loss after tax of 230.21 million Sing dollars. For first half of 2021, before the recent lockdown, the situation improved as operating hours of malls extended to 10 to 11 hours, and rental and service charge discounts were also reduced. So net property income for the first half of 2021 increased by 9.5% year-on-year due to Lippo Purimall, and also because of the low base effect from last year. Net income also came in at 22.2 million, while total losses after tax came in at 22.5 million after accounting for fair value losses. So if we don't include fair value losses, then Lamir Trust actually made a profit for first half 2021. If you look at more traffic, the visitor traffic was improving up to second quarter of 2021, and we expect traffic to fall because of the recent lockdown. So in late June, the Indonesia government announced restrictions on movement and air travel, a ban on restaurant dining, and the closure of non-essential offices, but only applied for Java and Bali. Subsequently, the Indonesian government extended it throughout the nation based on 4 levels as the situation did not improve. So Lamir Trust closed 16 retail malls and 6 retail spaces in these regions, and rental waivers to tenants will also be extended. So a few days ago, the Indonesian government extended these measures to next week for Java and regions outside Java categorized as level 4. So if you look at the new cases 7-day rolling average for Indonesia, the measures seem to be working, and it seems to have crossed the peak. So hopefully it will continue to decline, and the government will slack off too soon by easing restrictive measures too soon. If you look at the liquidity and credit profile of Lamir Trust, they have quite a good weighted average maturity of 3.29 years, and then they have no debt expiring in 2021. So if you look at the cash balances of 160.7 million Sing dollars, they also can pay for the loans expiring in 2022. So even with more restrictive measures because of the acquisition of Lippo Purimall, Lamir Trust should have high chance of registering low losses after tax at most. So there are very few comparables out there. So we compare with Lippo Karawaci, Lamir Trust sponsor. So Lamir Trust trailing 12 months EBIT over interest expense was at 1.31 times, and 0.97 times if you include for perpetual distributions. Lippo Karachi has negative trailing 12 months EBIT, but has turned positive in first half of 2021. If you look at the gearing ratios, Lamia Trust also have better gearing ratios as compared to Lippo Karachi. Lamia Trust bonds also have higher credit ratings than Lippo Karachi. So for Lamia Trust, we recommend the 2024 bond, which has dropped in prices recently due to the lockdown measures. And I think that it is offering quite an attractive yield of 6.77% now. So for those who are more risk-seeking, you may think that the Lippo Karachi bond, 2025 bond is also quite decent at 7.6%. If you look at the G spreads, it paints a similar picture with the 2024 Lamia Trust bond, still quite attractive, and the Lippo Karachi 2025 bond. So with that, I've come to the end of my presentation, and I'll be handing over the time to Kiki.
Hi, thank you, Sharon. And this is my turn to solve. Sorry, some technical problem. So this is my turn to share about what bonds I like. So honestly speaking, I'm with the first person, I think. So for my ideal bond investment, I like some bonds that can give me about 3.3 to 5% LT maturities. And two names I'm gonna recommend are Fosun International and Far East Horizon. So maybe firstly I talk about Fosun International, and then here you can see Fosun International. Here I give you some background information. It's a Chinese international conglomerate and investment company, and it has many businesses across different areas. And about 60% of the revenue came from mainland China, and 40% from overseas regions. So Fosun actually got 4 business units, which they namely health, happiness, wealth, and intelligent manufacturing. So you can see from the pie chart here, the top 5 subsidiary of the group, you can see which are Yuyuan, Fosun Pharma, Fosun Insurance Portugal, Fosun Tourism Group, and Peak Insurance. And they contributed over 80% of the total revenue. Okay, so here you can see we do see Fosun's 2020 results have declined significantly due to the COVID-19 pandemic, but as its health, wealth, and intelligent manufacturing segment record a sharp rebound in the second half of 2020. Here you can see in the graph, and the happiness sector turned losses into profit, while the Fosun Pharma and Yuyuan deliver steady performance under the pandemic. So, and also you can see Fosun Tourism Group also see great improvement under the pandemic recovery. So we believe Fosun its diversified business portfolio will continue to support the long-term growth of the group. And all right, so we go to the credit part. You can see actually we think its credit condition is largely stable, and Fosun its financial position remain quite healthy with sufficient cash reserve, bank credit lines, and strong financing channels. So its debt to capital ratio and net gearing ratio were keeping at the manageable levels. And also at short term, liquidity remained comfortable, and the average financing cost decreased to 4.8% in 2020. So we see the overall credit quality is quite good. And here came to the bond investment part. There are currently 8 Fosun International USD bonds in the market, and the yield to maturity of the bonds are ranging like 3% to 5%. And the bond credit rating at BB grade from S&P, so they are non-investment grade bonds. So among them, I like to choose the Fosun 2023 bonds. And as yield to maturity is about 4.4%, and the remaining investment period is about 2 years. As you can see, we know that short-term bonds need to face relatively less uncertainty. So that's the reason we think Fosun 2023 bonds is a better choice. All right, so this is the second one that I'm gonna choose will be Far East Horizons bond. So Far East Horizons is actually one of the largest independent leasing company in China. So it is a wholly owned subsidiary of key SOE, which is called Sinochem Group. So actually, for this horizon business divided into two segments, which are financial and advisory service and industrial operation. So the financial service and advisory service segment include direct finance lease, sales lease back, and then operating lease and other financial services. And so industrial operation business, Far East Horizon has equipment, hospital, and education institution operation businesses. So in terms of asset scale and profit scale, Far East Horizon rank among the top 5 in the domestic leasing industry, in China. So only after the top industry players such as ICBC Leasing, Bohai Leasing, and CDB Leasing, and and it just ranked the number 4 in asset scale. But you talk about like profit scale, actually it ranked number 2 in China. So last year, Far East Horizon's revenues and profits increased 8% and 5% respectively. Its overall performance was generally good under the COVID-19 pandemic. So you can see the income structure in the left-hand side, the interest income from leasing business as the main source of the income, accounting nearly 60% of the total revenue. So during the year, we see its leasing business has grown steadily, while its industrial operations segment deliver a fast growth for consecutive years. And so given the economic situation has been improved this year, it is expected that both its leasing and industrial operation business will be better in this year. And so come to here, the credit part, since the leasing industry belongs to a capital intensive industries, so its leverage level was generally high. As you can see, Far East Horizon's gearing ratio remained at 85%, which was in line with the industry average. And leverage ratios of its 3 financial leasing subsidiaries, they all met the regulation standards in China. So we see its non-performing assets ratios and provision coverage ratio here also keeping at a healthy level during the period. So since Far East Horizon is backed by a large SOE, and the company benefits from very strong shareholders background, right? And diversified financing channels. And it also, it is one of the Chinese largest ABS issuers. So its credit profile was pretty good, actually. So for the bond part, in February this year, Far East Horizon issued a 3-year senior CNH bond and a 3-year senior USD bond with coupon rates of 4.7% and 2.625% respectively. So given its BBB- credit rating from S&P and its sizable operating scale, we do like Far East Horizon's 2024 USD bond. because it gives you about 2.5 yield to maturity. But we also see better returns from its 2024 CNH bond. And here we show you, because it offers about 3.7% yield to maturity in 3 years' time. So it's really good for investors who have large sums of RMB on hand. So, all right, to sum up my views towards these points is quite positive, and because both Fosun and Far East Horizons are considered as good names, as they have strong access to diversified funding channels, including banking relationships and access to bond markets. And yes, so this is my recommendation. So now I pass it to Jackson to share some of his thoughts to us. Yes.
Okay, so it's my turn. So I have just shared about my view on the Asian high yield sector, as well as we are positive on the Chinese real estate sector. So here comes my recommendation about the bonds. So I will talk about the two Chinese real estate bonds to all of you, and try to tell you the attractiveness of these two bonds. So the first one is the LVGM China. LVGM China is actually a Chinese property developer, which mainly engaged in some residential property development, so supplemented by commercial real estate and hotel operations. So LVGM is listed on Hong Kong Stock Exchange with a market capitalization of about 9.2 billion Hong Kong dollar at this moment. So unlike some traditional developers, LVGM mainly acquires its land through some urban renewal projects. So as you can see in the photos on the right-hand side, this is two of their urban renewal projects, which includes the Shenzhen Mangrove Bay #1 and also the Zhuhai Dongqiao project. So in 2020, LVGM recorded a contracted sales of 5.1 billion RMB. So we consider this scale as a small-sized developer in China. So to measure the cash flows and also the repayment ability of LVGM or of those small-sized developer, we must analyze its future development by considering the project on hand. So LVGM currently, they have an urban renewal project in Baishizhou, serve as the key asset to the group's development blueprint. So to elaborate more, the Baishizhou project is actually the largest urban renewal project in Shenzhen, offering around 3.4 million square meters of construction area. So the location is in a prime area in Nanshan district. So the expected average selling price is very high, which is about around 120,000 to 130,000 per square meter. So we expected the contracted sales of this project will be around 200 billion RMB, so which is 40 times of LVGM 2022 annual contracted sales. So recently we got some good news, which is LVGM announced that the construction permit is acquired for the first phase of the construction, so which they will start the construction in this year, and the project will go on sale in 2023. So after the equity injection of Baishizhou project last year, we saw that the shareholder equity of LVGM increased by 90% year on year. So the credit indicators are greatly improved after the equity injection. So we saw that the net gearing of LVGM improved to 76%, and also the adjusted liability to assets ratio improved to 62%. So these two ratios have met the requirement of the three red lines. So LVGM becomes a yellow light developer. So on the other hand, you can see that its cash to short-term debt ratio is a little bit low, which is below one time. But however, we think that if that maturity distribution right now is quite healthy. So as you can see in the chart here, majority of its debt are concentrated in the 2 to 5 years time span, while the other debts are distributed in different time in different year range. So we think that this is actually a healthy distribution of the maturity profile. And the group also have no non-standard financing at this point. So given that even the cash to short-term debt ratio is quite low, we think that the LVGM can generate quite a stable cash flows and actually quite consistent in terms of their repayment ability. So the reason is that with the promising growth opportunities, LVGM is able to secure a very huge credit facility of around 20 billion with China Everbright Bank. And also in last month, Bain Capital also bought around 120 million USD convertible bond issued by LVGM. On the other hand, we also see that the sellable value of LVGM in 2021 is around 9.7 billion. And 95% of this land will be coming from Guangdong, including Shenzhen, Zhuhai, and Huazhou. So these are very some kind of first and second tier city in China, which can generate a very stable and predictable cash flow for LVGM. So on the other hand, for the commercial property and also hotel management prospect, we think that the expected sales cash flow can exceed around 1 billion, even annually, which this number is achieved even under COVID last year. So we think this kind of income is very stable, and therefore we think as a whole, on the group level, LVGM has a very decent cash flow and also manageable operational risk. So for the recommendation, we actually think that the LVGM bond due in March 2023 is very attractive because it is currently offering a yield of 10.7% at this point. So the double-digit yield given is a very decent credit profile and is single B graded bond. It is a single B graded bond. So we think it is quite an attractive opportunity for the investor. And therefore, we put this as one of my recommended bonds. The next bond I would like to introduce is the bond issued by Hobson Development. So Hobson Development is also a Chinese developer listed on Hong Kong Stock Exchange. So this company is much larger than LVGM. So its current market capitalization is around 80 billion Hong Kong dollar. So Hobson is a traditional developer in Guangdong, and the group was actually once the first Chinese developer to hit the 10 billion RMB annual contract sales benchmark back in early 2000. So apart from initiating its equity investment business in recent years, we also see that the group's property sales are rebounding quick and grow very fast, and now back to the top 100 list. As you can see in this table, Hobson Development achieved a very impressive sales growth in the last few years. So in 2020, they achieved a 50% year-on-year growth, while the sector average is around 12%. So in the first half of this year, the growth even increased to around 130%. So while the sector average is around 40 to 50% only. So we see that Hobson Development can consistently outperform the market in terms of the sales growth. So about the leverage, Hobson Development is actually a green light developer, which is able to fulfill all the free red lines under the regulations. So we see that, the net gearing ratio here should be around 86%, so which is not 8%, a typo here. So also the cash to short-term debt is around 1.6 times, and also the adjusted liability to assets is about 64%. So all these three indicators are quite healthy when we compare to other developer and other peers. And also, some key advantages of Hobson Development is that it has a very massive land bank size. So its land bank to sales ratio is sitting at around 18.7 times, while market average is around 4.5 times only. So this massive land bank could support the group's future sales growth for around 5 to 7 years. So on the other hand, because of the promising growth prospect, the borrowing cost of the group is also quite low, which is sitting at around 6.8%. So despite the recent turmoil within the real estate sector, we saw that the Hobson bonds were not affected much. Because it is a single B graded bonds, some of its single B rated peers has affected much during this recent market downturn, but Hobson Development is performing very stable. So last but not least, we saw that Hobson Development has ample cash on hand, and they demonstrated the confidence in their current liquidity. So they launched a large scale share buyback since last July, and also they called back their existing June 2022 bond, which is on our Bond Express, at around $103.5. So, which is actually a premium. So it demonstrated that the management is really confident in their current liquidity. So to conclude, we think that Hobson Development has a stable financial profile and also an ample land bank, and as a result, their bonds are worth considering. So the bond, which will be due in December 2023, is currently offering a yield of about 7%. So we think it looks appealing to investor, given its investment horizon is only about 2.4 years, which is quite a short term. So this bond is very attractive, and that's why we also put this into our recommended bond list. So that's the end of my recommended bond sharing part.